This is a wide-ranging video on the topic of absorption costing. It touches on many points and they are important, and it's important that you make your notes from the video, stop the video from time to time. Also stop the video and have a break. You can see it's quite a long video, 124 slides. But make sure that you understand the concept. It's very important to understand what's meant by absorption costing. It's an important topic within this area of study. So let's see. It's connected with how to allocate manufacturing costs to production. Or more specifically, it's looking at allocating overhead costs to production. Overhead costs are fixed, and the issue is how should they be allocated to production. And it's particularly problematic if the overhead costs cut across different departments. So the different departments have to share the overhead costs. What's the basis for them sharing the cost? How do they work out what is fair for them to take on as their part of the overhead burden? When we think of manufacturing costs, we think of direct labour and materials. So we have essentially two components. But then we've also got the overheads, which must be allocated to the products. And the reason why it's allocated to the products is to ensure that the company can cost the product. It knows what it costs to make the product because all the overheads have been apportioned to it on some basis. It knows what the direct materials and labour are, so it can work out the cost of the product, and therefore it can work out its price. If it didn't have this information, if the management didn't have it, they would really have to guess what the price of the product is, and that could not be perhaps a good position to be in. They may guess it wrongly and with catastrophic impact on the organisation. So management rely on it, but in fact, as discussed in other videos and will be touched on here, they're really looking towards using perhaps last year's calculations as a basis for this year's costing, because they need to price the product now, and clearly working out absorption costs is using historic data. It's using the data from the company perhaps in the previous accounting period, perhaps last year. But the company needs to know what the costs are now in order for it to work out what its prices should be. So management have got a problem, and they need to use their skills and their knowledge of the market and their knowledge of the costs of the raw materials and the cost of the overheads and the cost of all the various costs within the organisation to try to work out what the true cost of the product is, allowing for overheads. So absorption costing is not a panacea for pricing. It is, generally speaking, working, let's say, 1 year behind what it's actually needed. It's needed right now because the management need to price its product right now, but that's the best that they can get. So there is a role for management in pricing. It's not done entirely on the accounts. Absorption costing is a process of assigning the variable costs of production and the fixed costs of production to the product. So it's trying to work out how much of the overhead burden the product should bear. Now it's complicated because overheads sometimes cut across various departments. For example, business rates, business tax, for example, may be based on the maybe levied on the basis of the area of the premises. So it has to be assigned, it has to be apportioned to each department according to the amount they use. The apportionment should be reasonable. It should be fair. And then the individual departments will have to account for that in their returns, but also try to work out the costs of their production, including the overheads. So it gets passed on until finally the overall cost of the product emerges, which will include the variable costs and the fixed costs and the overheads, in other words, and that can be used by management. But as I said earlier, generally speaking, it's a year out of date or thereabouts. So management have to make the best of what they've got and use their knowledge as well. Variable costing only deals with the variable costs of production, as the term suggests, and assigns these to the product. The fixed costs of production are treated as period expenses. So in terms of the accounting procedures here, the fixed costs are treated as period expenses. I think we should make a note of what period expenses are. There are three different types of absorption costing systems. There's the job order costing, so job order costing. There's process costing, and there's what's known as ABC costing. That is one that we need to come back to quite a lot. Activity-based costing, and it's one that will be the subject matter of separate videos. Job order costing. Well, costs are assigned to the product in batches or in lots. So costs are simply assigned to the product in batches. For example, a company receives an order, then it raises a job order number and calculates the cost of completing that order. So the company receives an order, it raises a number, it makes a number for that particular job, and then it works out what that particular job will entail in terms of resources, both human resources, labor resources, and raw materials and components and so on, and it'll try to work out what the cost of the job is. Process costing, well, costs are systematically assigned to the product since there are no discrete batches to assign costs. It's a process. They're trying to cost a process, and processes are not discrete. They're not like job orders where there are discrete output. There's a number of outputs. Process costing tends to be more continuous. The product may be, for example, soft drinks, and therefore it's a continuous flow of production. It still needs to be costed. It's very difficult to work out the product. It's not a fixed entity. It's a continuous flow of output. ABC costing, activity-based costing, assigns costs from cost centers to the product, and we'll talk about this in much more detail later. But nonetheless, ABC costing assigns costs from cost centers to the product. This is appropriate in multi-product firms where there are different volumes for the various products. So where there are different volumes for various products, we would tend to use activity-based costing. We're looking at the activities of the business and costing the activities. So we're looking at the activities of, let's say, cost centers. For example, HR would be a cost center, or marketing, stores, dispatch, manufacturing, accounts, maintenance, and possibly others. So it's necessary to deal with these, but look at the activities that they are involved in. For example, HR may have some impact on health and safety. It may have some impact on training, on recruitment. Well, it will have impact on those since it is the HR department. However, that needs to be accounted for. So what's necessary is to see how much of that facility is being used in a particular product. But as I said, it's the subject matter of separate videos, and we'll deal with that later. Now let's take a simplified view of production. First of all, we have raw materials, purchasing of direct raw materials. We have also manufacturing, which is direct labour applied to direct materials, and overhead costs are incurred. And finally, or just about finally, we have finished goods and the stores. The production process is complete and the goods are moved into the stores and subsequently shipped to the customer or to the buyer, and they are dispatched to market. Now, accounting for the production process, well, direct materials are purchased and recorded as an asset. That's how the accounting process works. So direct materials are an asset of the business. The cost of direct materials placed into production is transferred from the raw materials account to the work in process account. So the work in progress or in process account is an asset. So it's moved out of the raw material account and into production, if you like. As direct labour costs are incurred, they are recorded in a labour expense account. Throughout the year, they are transferred from the labour expense account to a work in process account as an asset. So the accounting system starts by recording the various inputs, say direct material. It records it as an input, and then it moves through the various accounts. It's recorded as an input at the start. It comes into the organization, the raw materials. It's bought in, let's say, and then the accounting system starts to register it and register it through the various processes. So it eventually becomes a work in process or a work in progress, depending on how you see it. Overhead costs are initially accumulated in expense accounts, electricity, depreciation and so on. Throughout the year, they are also transferred into work in process. So they start by just as being an expense, but as they move through the production system, they become work in process. When goods are completed, their costs, direct materials, direct labour and overheads, are transferred out of the work in process and into the finished goods account. So we see there is an accounting framework managing the whole system. It's not just simply that the goods arrive and are processed and churned out at the end and sent and dispatched to the customer. They are accounted for all the way through, going through from an asset and being an expense at the start and turning into an asset and going through various accounts, registering where they've got to in the system. When goods are sold, their costs are transferred out of the finished goods inventory, the asset, and into the cost of goods sold. Now that particular account is also known as COGS, cost of goods sold, and it's an expense. Accounting for manufacturing costs. Well, initial expenditure on raw material, direct labour and overheads are capitalised. They're recorded as an asset in the work in process and finished goods inventory. So these various items, raw materials, direct labour and overheads, they're capitalised. They're put into recorded as assets in the work in process and finished goods inventory. They're transferred to expense accounts when the finished goods are sold. They go to the cost of goods sold. Generally, the cost of goods manufactured, the cost incurred in manufacturing the product, will not equal the cost of goods sold. So the cost of the goods manufactured will be different from the cost of the goods sold. This means that in any year, some of the costs associated with manufacturing the product will not follow through the income statement as an expense. They will remain in the inventory account as an asset. It depends really on what happens to the goods as they go through the system. Sometimes the goods are kept within the system and they will be kept in one account as opposed to completing the journey and becoming a finished product which is sold on and cleared off the accounts. So by and large, the two accounts may not coincide. They may not agree in terms of their valuations at the end. But there's nothing to worry about, because in the long run, over many accounting periods, they will adjust and they will balance. Consider the following example. A company is formed to manufacture, say, small car components. It starts the year with, let's say, £10,000 in cash and equity. During the year, the company incurs £5,000 in payroll costs, £1,000 in rent for the plant, and £1,500 in raw materials. And during the year, the company makes, let's say, 100 components. So the problem is, what will his or her profit or loss be if it sells no components? And what will the profit be if it sells 100 components at £90 per computer or per harness or whatever it is that's going into the car? Well, let's take what we know. We know the startup is 10,000, the payroll is 5,000, the rent is 1,000, raw materials 1,500. We have two types of sales here. We have one where nothing is sold. That's one possibility. Or the other is where 100 is sold and it's sold at £90. So if we take the 100 times 90, it's 9,000. And now if we add up the labour costs, the rent and the raw materials, they come to 7,500. So in a sense, the outgoings are 7,500. Note here, we're not accounting for the startup cost of 10,000. It depends on which perspective we take. But since we are actually looking at the costs of the product, then we leave out the startup cost. Whatever profit is made can be a contribution towards the startup costs. And in this case, it'll make £1,500, which we record as a profit. So the £1,500 will be a contribution towards the startup of £10,000. In the other case, it can sell anything. So now it has labour costs, rent and raw materials, and it's still got them at the end and hasn't made anything, it hasn't sold anything, so the outgoings are 7,500. So in this case it's lost 7,500. It also has the startup costs of £10,000. Now the job order costing. Well, job order costing is one method for allocating the costs of manufacturing to the product. In job ordering costing, the manufacturing costs are allocated to the product by batch, by group, if you like. So the job order costing, the manufacturing costs are allocated by onto a group. Job ordering costing is appropriate when the firm makes products in small batches, and each batch consumes different amounts of direct labour, direct materials and processing time and energy. So the batch would be costed. Perhaps each item in the batch may be slightly different, and it would be simply too much work, too complicated and too detailed to perhaps cost each of them separately. And they also could be seen as quite cheap or insignificant, and therefore not necessarily economic in spending time doing it. So the whole batch may be costed instead of the individuals within it. Job order costing. Well, a survey of the cost and management accounting practices in the Management Accounting Research Centre indicated that job order costing in the primary is the primary method of costing in the following industries: in electronics, in machinery, computers, furniture and fixings. So job order costing is quite popular. A job order simply means that the order comes in for a certain item and the company raises an order number and then will set about costing the product, which will be invoiced to the customer at a later stage. Now, absorption costing. Well, consider a small engineering company that manufactures components for, let's say, the car industry. Let's say they receive an order for 70 new design components. They need to determine how much it costs to manufacture these components. The batch of 70 components starts with the introduction of raw materials. So there'll be 70 component cases, 70 integrated mechanisms and electronic components. These could be perhaps known as harnesses. 70 assembly packages. Now, workers assemble the parts and special machines are also used. So now it's a question of trying to work out what these costs. The job order costing, the manufacturing costs, are allocated to the product by batch. Thus, the company allocates manufacturing costs to the 70 components. So the job is assigned a lot number, so a lot whatever. Let's say it's assumed 0812. That's the cost of this particular job for these 70 components. The stores provides the various parts, allocates the costs of these raw materials to lot 0812. So the stores first of all costs out the components that are going to be used. The individuals that assemble the components record the time spent assembling the components on their timesheets, and the accounting system will allocate the payroll costs at the hourly wage rate to the job. So the assembly time is also being costed. Finally, the cost of the plant, the cost of the specialized machinery, the utilities, the accounting system that tracks costs within the plant, the accountant running the system, and all the other functions involved in acquiring, processing and delivering the components must be allocated. So some means for allocating those must be worked out. And once that's done, then the job has been costed. The job can then be completed, and an invoice could be sent to the customer for payment. It could be that the management have done similar work in the past and will know the figures very precisely and may be able to invoice the customer earlier. But it depends on custom and practice within the industry as to what is acceptable. So it's known as overhead allocation, the final bit. Now, the absorption costing thing, the job order system. Well, we have a lot number, whatever it is, say in this case 1118. We have direct materials, let's say 70 component castings at £60 each. So they would be costed out from the stores. 70 circuit boards at £32 each, 70 components of certain types at £96, 70 gaskets and fitments at £13 each. The total direct materials £14,070. Direct labour and overheads, well, the employee number, whoever that employee is 08237, whoever that is, and they work certain hours. They work 37 hours in this case. Sorry, the employee number is 082, and they work 37 hours at £27.50. That's what they're costed out at. So, in other words, the cost of the job is going to be £1,017.50. Overheads are allocated at £121 per direct labour hour. So maybe that was the basis on which overheads were decided that they would be allocated. So it was decided that it would be based on labour hours, and it worked out to that figure. So the total direct labour will be £5,494.50, given a total cost of £19,564.50. And then, of course, a markup would be added to that, and the customer invoiced. The markup may be 50% or 100% or some percent, again depending on customer practice within the industry, but a certain percentage will be added on to generate the profits. Now, job order costing. Well, a natural question to ask with this example is, how do we determine the overall allocation rate, the overhead allocation rate? Well, it's difficult. We've fudged over it by simply saying it was based on labour time. Well, it could be equally based on machine time, or it could be based on some other basis. But again, management have to make a decision as to which one's most appropriate and which one's going to be most effective. But there is a tension. They have to make sure that the price is not excessive, but at the same time the price should cover all of the costs of the business, plus some allowance for profitability and the return on the investment that the original investors had in mind when they went into the business. So estimate total overhead for the plant for the year. Now, this is one way in which it may be possible to allocate. Just look at all the overheads for the plant for the year and select an activity base to allocate the overhead cost to the product. Estimate the expected usage of the activity base. And then overhead allocation rate is the estimated overhead costs divided by the estimated activity base. In other words, look at the estimated overheads of the business and divide by the likely amount of output that the business is going to produce in that time period. And that would be an indicator of the of the overhead allocation rate. Suppose a company estimates overhead costs for the plant to be £100,000 and direct labour hours to be say 1,000 hours. Well, what's the overhead application rate? Well, it's 100,000 divided by 1,000, which is £100 per hour. So that's the estimated overhead costs for the plant for, let's say, a year. And that's an estimate that management have to come up with based on their experience, based on what they know about costs and what they know about the market and what's happening in terms of rates of inflation and costs within the market for the components and the overheads that they need. Let's say to come up with £100,000. And they expect 1,000 hours of work from the workforce, so it's going to be £100 per hour. What happens if the employees only work 750 hours? Well, the amount they're going to charge per hour is going to increase. And if the employees work more than 1,000, then it will decrease. What happens if the price of heating oil is greater than expected? Well, heating oil is a variable cost, and that presumably can be worked out more precisely. And cost accountants and management accountants should be able to work out precisely what that is in terms of its cost within the final product. So not necessarily worked out in terms of what we've got on the screen in terms of labour hours. Now, process costing. Well, a process costing is used when a manufacturing company makes large volumes of identical products. For example, pharmaceuticals, bottles of Pepsi or gallons of oil. So process costing is when a company makes large volumes of identical products. Each unit consumes the same amount of direct materials, direct labour and indirect costs or overheads. So it's making large amounts of these products, so therefore the direct materials, the direct labour and the indirect costs, the overheads, will be the same for each standard amount of the output. Instead of assigning cost to jobs, then average costs the job to get a per unit cost. So the average across the job, they work out the flow of the production, they work out how much has occurred and in a certain time period and what the costs within that time period will be, and then they can work out what particular quantities will cost. Process costing assigns costs to the product through each process the product goes through. So we go through, let's say, mixing, bottling, distribution, and each one will have a cost and will be added to the next until a final calculated cost of the product is worked out. Consider a soft drink producer. Well, there's direct materials, sugar, water, colouring, and these are mixed. They're poured into a bottle, carbonation is added to make it fizzy, and then they're capped. There'll be other processes, they're labelling on the bottle and also, that sort of thing. But those are essentially the processes in making a soft drink. Now, how does process costing differ from job costing? Well, survey indicates that process costing is most often used in the following industries: in oil refining, in chemicals, in pharmaceuticals, and in food and beverage. So process costing will look at large volumes of output, work out the costs for the large volume, and then divide it up into the units in which it will be finally sold on. And that will determine the price of the individual units. So they will have a run on making a large quantity, work out the costs of making that large quantity, and then divide it by the number of units that the customers will expect to receive, the size of the units the customers will expect to receive, divide the total run by that, which will give you the total number that's been produced, which of course will be then worked out as an average. Just simply divide the total cost by that number, which gives you the costing for that particular run. Absorption costing problems. Well, in an absorption costing system, such as job order costing, what happens to plant profitability if additional output is produced and not sold? Well, that is a problem. Um, if additional output is produced but not sold, then it complicates the calculations considerably. And it would take time and effort to try and work out what the precise costings would be, just for the ones that were useful and which could be sold. But clearly the ones which are not sold, they are dead weight, and they need to be accounted for as well. They need to be assigned to the items that have been sold, so therefore the ones that are sold will be more costly as a consequence of this mistake, of the extra production which was not sold. Hence it's very important not to make this mistake. Suppose you allocate overhead using direct labour hours, and a special order comes in that requires the factory to be completely recalibrated to process the job. Will this cost be traced back to the job? So what if a considerable order arrives in the factory, but it means that the machines have to be switched over to producing this particular item? They have to be recalibrated, they have to be retooled perhaps. Now, should that job pay for that retooling? Or should it just pay for the usage of the machine whilst making the output that's going to be sold? So you can see there are problems, and this does require management decision making and also knowledge of the market. Customers may be reticent to pay large sums simply because tools have to be moved around and machines have to be recalibrated and changed over. That's not something that they expect to pay for. They expect to pay for the raw materials and the labour perhaps, and some contribution towards the overheads of the business, but not necessarily paying for the business having to retool all its machines or recalibrate the machines. So can the management of the business expect or get away with charging the customer those extra costs? And that's difficult, and it's difficult to say what the answer is. It really is a managerial decision. Variable costing. Well, variable costing tries to reduce the incentive to over produce by charging fixed overhead costs to expense in the period they are incurred, and allocating only variable costs. So variable costing is a way in which the business tries to come to terms with the fact that it needs to reduce the incentive to overproduce. So if the overheads are committed, then there is a temptation to overproduce because the overheads are already there, they're accounted for. But if it's based on variable costing, then clearly the more that's produced, the more the costs will be recorded. So using variable costing is a way in which management can control what is happening and introduces more efficiency into the system. Clearly the overheads still have to be accounted for, but more focus is placed on variable costing to try and minimize the impact of variables, variable costing, raw materials, wastage in raw materials, direct labour, the usage of direct labour, making sure that the costs are kept down in those areas. And that of course will also minimize the contribution of the overheads. The overheads will be used less, perhaps. There'll be more throughput so the overheads will be spread over a greater quantity. Increasing production does not allow a firm to move fixed costs out of the cost of goods sold and into inventory. And that's it. It's a long, winding video with a lot of issues discussed. It's wise to go back slide by slide and make your own notes and do some additional research into this topic. There are other videos on the topic. It's complex and it's difficult to get a precise fix on the topic, but it is important because it is the basis for pricing. Pricing must be based on something, and it's based on the costs of production. And the costs of production have to be worked out precisely. And the costs of productions are complicated because of the impact of overheads and how overheads are absorbed. And there are different approaches. There's the job approach, the process approach, or the activity-based costing. So there are three approaches. And so far we're just talking in general about the problems of absorption costing. We haven't dealt in great detail with any of these. We've looked in this particular video at job costing and we've looked at process costing to some extent, but activity-based costing will be the subject of a separate video. But that's all we're going to deal with here, so let's leave it at that and say thank you for watching.